What's going on with Silicon Valley Bank? Banks failing? Is this another 2008? What are we supposed to do as individual investors? We're going to talk about that coming up. My name is Joe Conroy. I'm a certified financial planner, and I help regular, everyday people plan for retirement, long-term financial goals like college education for their kids, so on and so forth. So it's no surprise I've had a lot of questions about Silicon Valley Bank, bank failures. What are we supposed to be doing in these very tumultuous times? So let's talk a little bit about what's going on. Silicon Valley Bank went into FDIC receivership. It failed. We'll talk a little bit about what that means, but I think it's important to mention right off the bat that the government came in over the weekend and said that they were going to guarantee any deposits beyond FDIC insurance. Now, if you're a stock investor or a bondholder of Silicon Valley Bank, then you're probably not going to be made whole. If anything, you're lucky to get pennies on the dollar, in my opinion. But depositors will be made whole. It's an injection of confidence into the banking system when it probably needs it. So when we talk about a bank failing, it brings back 2008 PTSD, at least if you're an investor back then or a financial advisor like I was in those times. Silicon Valley Bank is the largest bank since Washington Mutual, 2008, to fail. So is this a big headline, or is the media making a bigger deal of this than it needs to be? It's kind of a big deal, but probably overblown in the media, which isn't really a surprise for most of us watching. But it's different than 2008, and you shouldn't be as concerned, although a lot of the headlines and things you're going to click online might scare you. 2008 was a credit issue. Banks had loans that they said were worth 100 cents on the dollar when really they were worth 10, 20 cents. Mortgages, and then that spread out to the rest of the financial cycle, which I should point out eventually corrected and went on to reach all-time highs in the stock market. But we don't want to go through that again, and I don't think that's the case today, because Silicon Valley Bank is a little bit more of a concentrated issue than an overall banking problem. Banks have to report what their balance sheets are worth, and they have to invest in very investable grade assets. Some of those assets are longer-term treasuries, which SVB had. Now, the problem is they bought a lot of those prior to the interest rate cycle of hiking that we've seen over the last year and a half or so. So there's an interest rate risk that as interest rates go up, bond prices go down, and that is where Silicon Valley Bank had a balance sheet that was shrinking. The other problem was that they also served the technology-based startup .com tech community. Since interest rates are going up and lending costs are going up, that hurts growth companies like the technology sector, which Silicon Valley Bank almost exclusively serves. So we've got a shrinking industry, and its bank was over-leveraged on these treasury bonds without proper risk mitigation. There's ways to hedge rising interest rates. Silicon Valley Bank just failed to do this properly. That's what put it in FDIC receivership. If you own or if you have deposits in a bank that has a diversified mix of customers and a good balance sheet, then I don't think you have much to worry about, especially if you're within those FDIC insurance limits. The main problem, in my personal opinion, is that if folks lose confidence in these financial institutions with deposits, it could create a run on the bank, and that's what happened at SVB. There were a group of tech investors and startups, and they started to see a little bit of smoke, and they headed for the exit, and they basically yelled fire in the theater without actually seeing it yet. Billions of dollars exited, and it just absolutely collapsed what Silicon Valley Bank was able to do. The spillover risk of that happening in other regions and other banks all throughout the country, not enough to make me lose sleep at night. Most of the folks watching this video, at least folks that are clients of Hartford Retirement Planners, keep FDIC insurance limits within the allowed amounts. And if you're not sure if you have FDIC insurance limits, this is an answer a question that I answer quite often for clients. So reach out to us and we're happy to tell you if you're fully covered or not. But this brings us to the final, what are we supposed to do as individual investors? Is this something that we should take action on? You know, there's a lot of parallels for the way that Silicon Valley Bank was overly concentrated in one sector and invested in one specific type of asset that ended up going against them. So what we should be doing as investors is maintaining our long-term approach where we have diversified investments over multiple asset classes, so we don't find ourselves as a household in the same type of situation as Silicon Valley Bank. Diversification is what gives you options, so no matter what happens in the future, hopefully the thought is that there will be different asset classes that will do better than others and give you options to not be forced to sell things when you don't need to, as you fund retirement or pay for your kids' school or whatever it is that you're working towards in your financial life. So, long-term investors, in our opinion, stay diversified, stay invested, shrug off the scary headlines, and keep your eyes on the goals and your plan. If you're not sure which goals your plan are, contact a financial advisor, and we certainly would be happy to help you. Thanks for watching.